Investing, it's more than just growing money and becoming rich. There's a lot to it. One of the main reasons that people will invest is to be an arch nemesis of everyone's personal finance, which is inflation. Ultimately, investing is there to achieve a goal. Your goals could be to retire comfortably. History has shown us since 1900 to 2023, the US stock market has provided around a 9.5% return. The UK just a bit less than that, still above 9%. In that time period, inflation has averaged about 3.8%, but it's not been smooth sailing. We've had a global financial crisis, we've had a pandemic, and in those times the stock market tanked. But guess what? It has always come back up. Most people are bad stock pickers, and most people are bad investors. How do we lose money in a vehicle that's been going up for many years? And it's because there are two categories of psychological biases that we have. One is our emotional bias. The other one is what we call our cognitive errors. A common one is confirmation bias. The truth of the matter is, wealthy individuals, they usually have financial advisors who will tell them that if you have more than a 5-year time frame for your cash, you probably do not want it in a cash ISA. You want to, don't just get the knowledge, that's not enough. You have to comprehend the knowledge. But in terms of actually doing it, the formula is very simple. You have to earn more than what you spend and then use the difference to accumulate assets.
You're not defined by where you come from.
Yeah.
And I think that's a big message that I always want to tell people.
Like you have to be able to be uncomfortable. Like be comfortable with being uncomfortable.
When you grow up in ends, you don't realize it when you're confident, but you have an audacity to do things that ordinarily most people wouldn't be willing to do.
Welcome back to another episode of the podcast. We've got a special guest in the building. Jacques is an investment management professional with 10 years experience in the asset management industry. Jacques, how are you doing today?
I'm doing good, you know. So I'm back in the gym.
Okay,
bro,
good,
I'm
good.
back in the gym. And I'm saying this because I've just come back and I've done leg day.
Okay, man.
Bro, my legs are killing me. so I'm doing good, but my legs are killing me, man.
You know what? Leg day is always the toughest because you got to walk all day, every day, right?
Bro. Like, I don't mind the upper body stuff, but the leg day, bro, I'm struggling, man.
Mad. So obviously, I gave a bit of an explanation about you from my perspective, but from your perspective, who is Jacques?
Who is Jacques? So, Jacques wears many hats. Jacques likes to call himself a servant of God, first and foremost. Amen. I'm a Christian. I'm also a husband, quite newly married, nearly 2 years in. And do you know what? I don't want to start a podcast so deep, but several years ago, I lost a friend, 2018, and before she passed away, she sent me a voice note. And in that voice note, she was just saying, thank you for being such a good friend. Thank you for being genuine. Thank you for being real and honest and stuff like that. And I really held on to those kind of like descriptions. So I always say something like, if I was to, pass away, how would I want to be remembered? I think those words were good. So someone who's just genuine, kind, someone who loves people, and that kind of stuff. But notice I've not said anything about finance yet. So, I like to identify with my character first. But yes, on a financial side, my day job, I work as an investment manager. I also am a bit of a social entrepreneur. So I run a business, a social enterprise called Walk Finance with a very good friend of mine called Peter. And that business is essentially for young people between the ages of 11 to 21. And essentially what we're trying to do is just educate young people on personal finances, get them talking about things that I never got taught when I was younger, at home, in school, etc. And we also have a podcast called Walk Finance. And then I'm also a personal brand. So I go by Jacques Financial, JAX Financial. And I do a lot of one-to-one coaching, group coaching. I speak a lot as well. I love to speak at churches as well. That's something I'm quite well known for. But yeah, that's Jacques, man. But yeah, I wear many hats.
I love that. Very, very detailed description in different areas. And I love the way you broke it down, especially talking about, your inspiration for your friend describing who you were to, you know, what you do in terms of your job to like on the entrepreneur social side as well. I really like that, man. That's really cool. So want to talk a little bit more about your story. Where are your parents from?
My parents are Ghanaian.
Okay,
They're
cool.
Ghanaian, yeah. So I like to say I'm half Fanti, half Ashanti. I'm like mixed race. So
Okay. Also, 2 different tribes.
two different tribes.
Okay,
Yeah.
mad. Mad. Were you born in Ghana at all?
I
or-
was.
Okay.
Many people don't know. Yeah, I was
Okay,
actually
cool.
born in Ghana, but I've basically lived here my whole life because I came in Kuala Lumpur.
Oh, you came in quite young. Whereabouts did you grow up then?
I grew up in East London, Hackney.
Okay.
So yeah, I lived in Dalston for quite a while.
Mm.
And then I moved to Clapton. So
Mm-hmm.
both inside Hackney. And
Yeah.
yeah, that's where I grew
How
up.
did you find it growing up in Hackney? Hackney had a reputation when I was
Yeah.
young. I remember, like, don't go Hackney, this and that. Yeah.
It builds character.
Where does everybody get this phrase from?
It builds character.
character.
That's what you gotta say. It builds character. Look, like I was a teenager during the early 2000s. At the time, there was a huge gang culture. It was the era of grime music.
Yeah, grand.
So no, it wasn't easy. You know, living in an area where everywhere you turned there was a different gang, for example. But I have many happy memories growing up in Hackney. Dalston, I remember finishing primary school. I'm just trying to get home to watch Pokemon. But my mum will walk through Dalston Market, and she knows everyone there. She knew everyone there. So I have so many memories. Even now when I drive past like Dalston, I'm like, wow.
Yeah.
So many flashbacks. And I loved playing football when I was young, and I've got so many amazing memories scoring amazing goals at Hackney Marshes.
Okay.
So
that's what you used to play, yeah?
Yeah. We used to play a lot of games at Hackney Marshes. That was like our home ground kind of
Yeah.
thing. So yeah, many good memories in Hackney.
Mad. And did you school in East as well? London as
Yes. So my secondary school, my primary school was in Stoke Newington, which is north, but it's still Hackney.
well? Okay.
And then my secondary school was in Hackney. Used to be called Hackney Free. It's changed its name since.
Okay.
And yeah, my college was in East London as well, but a bit further out.
Okay.
Yeah,
Mad. And then college, university, what about that? How did that like come about? And,
Yeah.
What college, university did you go to?
So the college I went to was called Sir George Bonnex.
Okay, no, I don't know it.
You haven't heard of it?
Nah,
Oh,
no,
right.
no.
It's
I'm from
in-
South, so
Of course, yeah.
so I don't
If-
know East.
If you're from
colleges,
East/North, you probably have heard of Monarchs College. Is in Walthamstow/Chingford. So yeah, I went there straight after my obviously my secondary school. I studied A levels, maths, economics, and media studies.
Okay, so you did it from early finance. type stuff,
Whoa,
yeah.
I mean, do you want to know how I picked those subjects?
Yeah.
Yes. So I was always like okay at maths. I was okay. I was pretty decent at maths. I don't call myself like an amazing mathematician, but I was probably, in class I was always in a top quartile. Let's put it that way. So when it came to actually choosing your A levels, I decided to do maths as an A level. I decided to do media studies because I loved watching movies growing up. Yeah, that's literally the reason why I picked it. And I didn't know what else to choose for my final subject, but I just heard of this subject called economics, and it just sounded like it would make me smart. So
Make you smart, yeah, for real.
Seriously. And obviously, I heard that if you're good at maths, you'd be okay at economics. So yeah, that's how I ended up choosing it. I really didn't know what it was.
Okay.
And there's a whole story behind
Yeah.
from A level to university. There's a whole story behind my journey with economics.
Okay. I mean, you kind of still are, let me say, leveraging some aspect of that, right? As a investment and management professional, right? I guess what was the motivation actually for pursuing a career in finance? Because it's very, usually most people, if they're thinking of finance, is like accounting or it's business, but the role you're doing is very
Specific,
it's very specific, yeah.
Do you know what? I'll be honest, it's not something I knew back then that's what I was going to do. So continuing the journey of like going into college and picking economics, it was a hard subject. I really struggled initially. I don't know if you want the long form or the short form, but there is a story where I was, studying economics, and we had a test. We had this test in the first few months, and everybody failed.
Everybody in your class failed
Everybody in my class failed the test. And I remember so well, my the head of year came into my class. His name was Mr. Barry Reeves. He was just shouting his head off. Like, he was like, you guys... And I just remember sitting in the front row, because I sat in the front row, and he was just spitting. I was just like, oh, gosh, man.
Right, they're spitting, you know.
Do you know what I mean?
You know, when they're so angry, they're going red and
he was an old man back then. He loved his subject. He was at retirement age, but he was just teaching because he loved it. So he was passionate about the subject as well. And anyway, he was he was really angry. He said, we're all going to do another test in 3 weeks' time, and whoever gets less than a D grade will be kicked off the course.
Wow.
Now, back then, you only had grade A to E and NFL kind of thing. So, yeah, I was like, okay, fair enough. We'll do the test, right? But I also played for the Monarchs football team.
Okay.
And we had a big game coming up with one of our rivals. Now, the rivals at the time was Leighton, which is just down the road, another college just down the road. And essentially, it was on the day of the test. And me, I'm a good student. So I went to my teacher. I said, sir, look, I've got a football game on this day. Can I do the test earlier or later? And he was like, no, you have to do the test. Bro, I can't lie. I went to the game.
I mean, come on.
Come on.
The biggest rival.
Do you know what I mean? I wasn't going to miss that game. And I was going to see even some of my old ex-football mates from school who played for that team. So come on, I can't miss that game. Anyway, so I got in trouble for that. They called my mum and my dad in. They said they were going to kick me off the course and all that kind of stuff. And I remember sitting there, just sat there, mum there, dad there, and they're just having a go at me. My mum is like, oh, we've been trying to tell him to study. And I'm thinking, I'm not even a bad student. Do you know what I mean? And I remember mum almost pleading for my teacher to let me stay. Mm-hmm. And I just remember telling myself that, nah, I got to do something. But long story short, I did a test and I absolutely smashed it.
Okay, wow.
They actually let me do it later because I did miss it.
Yeah.
And I absolutely smashed it and I got the highest grade.
Wow.
And the head of year pulled me into his office and said he really believes in me. He thinks I'm an amazing student. He said I'm quite good at critical analysis at the time. I remember that very well. And he thinks I can do really well. Mm-hmm. And just that kind of investment in faith in me just took me to another level, and I just became addicted to the subject. Okay. Up to now, I would say my favorite time studying was at college.
Okay,
yeah.
So economics became the favorite.
It became the favorite. Yeah, it became from the worst to the best. At the time. Yeah,
because of that.
Yeah.
It's always crazy how teachers I feel are so important to your life, especially when you're growing up, and you're in school and stuff like that. That belief that they instill in you is so important. It's a difference if they say they don't believe in you versus they believe in you. So it can make or break you almost, I
mean, this is a grown man. He was probably about 70 at the time. And for him to literally just pull me in a room, he asked to see me and to say he thinks I can do really well with economics as a career even going forward. Yeah, it gassed me, man. I was really I can do this. So I used to even practice essays, practice exams, and then get him to mark it. Wow. I even done my A-levels early. So I knew I had at least a B grade before the second term kind of thing. So that was the beginning, man.
Wow. So fast forward to today where you're, investment management professional. How did that come about? How did you get into it?
So after college, went to uni, done a degree in economics. When I was at uni, I realized the category of subjects that I really enjoyed in economics were financial economics and macroeconomics. So I went on to master in that. So my master's was in applied economics and financial economics. But even then, bro, I'll be honest with you, I didn't really know what I wanted to do. Of course, at some point I just said, I want to become an economist, right? Ultimately, that's the career path. At university, almost everybody that studied economics wanted to become an investment banker. Now, the truth of the matter is, when you grow up in a low socioeconomic background, there's no context in terms of careers. So I don't know what an investment banker is.
Yeah.
Right?
For real.
I just know that everybody on my course wants to be this thing. And unfortunately, if I'm honest, I applied for a lot of investment banking graduate schemes. And I did get far in the process, the recruitment process, but I always failed at the assessment center. And I never really understood why. And then after that, I said, you know what, I think I want to advise people on their personal finances. So this was even back then. And so the career route, as you probably know, is to become a financial advisor, right? But again, when I was doing my research, and quite naively of me, it looked like financial advisory was a career of just selling financial products. It
Okay.
wasn't what I thought it was.
Yeah.
So I just quickly kind of moved away from that. And then when I graduated, it was tough. I kind of just fell into a role. I was working for the back office, an admin type of role in a wealth management company. And that was my first introduction as to what wealth management, asset management actually is. And actually, I thought that's what investment banking was. But they're two different things.
Okay, yes.
Yeah, investment management, asset management is probably what a lot of people think investment banking is.
Yeah, I
Investment
think
banking,
so.
a lot of it is
Yeah.
mergers and acquisitions and prop trading. And you can have an asset management division in an investment bank. But the art of investment banking is not investment management.
Okay.
And I just really enjoyed it. And I think to answer your question is I also went on what I call a personal finance journey, which is I wanted to learn how to build wealth for myself. I wanted to obviously come out of the kind of socio-economic background I was brought up in, which is a low income, kind of lower class background. And it tied in perfectly with my career because I was learning about investing, but I was also working in investment management.
Yeah.
And so my growth was exponential since then.
Wow, that's amazing. So as an investment management professional, what does your work kind of entail? What do you do on like a day-to-day basis?
Ooh, so without being too technical, my
Yeah,
job
we like
to
jargon free. You
Yeah,
know,
yeah.
You've got that same motto as well, right?
Yeah, because there's a lot of technicalities involved. So
Yeah.
I'm going to try my best to keep it jargon free. But to cut a long story short, so you will have, and it might be different for different companies, but the company I'm working at now, you will have almost like a relationship manager / an account director who will go out there and win the business, pitch to clients, etc., different types of clients. So we've got private clients, which are essentially ultra high net worth individuals and families. We've got institutional clients. We've got corporate clients or businesses. And a big part of my company's client base is also charities kind of thing. And so they will win the business. And then when they win the business, they will set something called a strategic asset allocation. Jargon, but I'll explain. What that means is based on what the client wants, the account director will decide what mix of investments will actually allow the client to meet their goals.
Okay.
And so what it will look like will be something like, because you are a long-term investor, you've got 30 years, we're going to put 70% of your portfolio in equities, which are known as stocks and shares. If it's a short-term client and they've only got 5 years, we may put the majority of the portfolio in bonds, for example. And I could explain those in a bit more detail. But once they set this strategic asset allocation, then it comes to my desk.
Okay.
And then my desk are responsible for what we call tactical asset allocation. So 70%, as an example, before will be the equities, that's the strategic.
Yeah.
But if we feel as if the macroeconomic environment positions certain asset classes to do well in the next 3 or 6 months, then we may push that limit to 75.
Okay.
If we think equities are going to do better than bonds in the next 6 months, we will overweight equities and underweight bonds, for
so
example.
you put more money in equity. Okay.
Precisely.
Okay, cool.
So a big part of my job is doing that.
Okay.
And those portfolios, they come with mandates. Each mandate can be quite sophisticated.
Okay.
I'll give you a very quick example. If you have a charity that, let's say it's a animal charity, and that's your client, they may say, hey, look, we don't want any of our portfolio to be invested in any company that does animal testing. So we have to build a portfolio that excludes these type of assets, and that's part of my job as well. But there's more technicalities, but
interesting.
we don't need to go into that.
It's so funny that you say that, because I don't know if people would even think that even charities are investing. It just shows you the power of investing. That is insane.
Yeah, majority of our clients on my desk are charities.
Wow.
Charities need to grow their capital.
Yeah.
They need to use the income from their investments to do things. So I'll give you a very simple example. A charity, like an endowment fund, may need to invest, and the income that portfolio generates is the income they use to make grants, for example.
Right,
So investing, and we could talk more about investing, I think, when we're going to get there. it's more than just growing money and becoming
Yeah.
rich. There's a lot to it.
You can, like you say, use it for other stuff, right?
Absolutely, absolutely.
So interesting. And actually, on that topic, what is investing for?
Yeah.
Again, we like to be jargon free on a podcast. What does that mean?
Yeah, so investing is essentially kind of trading your cash, right, for something that has a high potential of going up in value or providing you with a return. So, we earn money, we work hard, we get some money. That money can be seen as capital. And then we use that money to buy things that will either grow in value, these are called assets, and those things can often kind of provide you with an income as well. So that's what investing really is.
Okay, amazing. I love that answer, and it's straight to the point and simple. That's what we like. We love simple. We don't like all the complications and is this and that.
Yeah.
Love that. And why should people invest? What's like the benefits of investing?
So there are many reasons why people should be investing. I always say investing is not something we do just to get rich or to build wealth, but it's non-negotiable. One of the main reasons that people will invest is to be an arch nemesis of everyone's personal finance, which is inflation. Inflation is defined as the general rise in prices of goods and services. So things are always becoming more expensive. And as things are becoming more expensive, the value of our money is going the opposite way, right? And so if that's the case, what can we do to preserve the value of our hard-earned money? Well, we have to trade that thing for something that at least matches the rate of inflation. Yeah. And essentially, that's one of the reasons why people should invest. But investing could be done for so many other reasons. I always say when you're building a portfolio, that portfolio is there to either solve a problem or help you to achieve your goals. Your goals could be to retire comfortably. You need to invest to do that. It could be that you've inherited a large sum of money and you need to use that cash to generate an income for yourself. You have to invest to do that. So there's many reasons why people should be investing.
Love that. Absolutely love that. And what can people invest in? You've mentioned a few. You mentioned stocks and shares, bonds. What else can people invest in?
So let's talk about that. Let's talk about the asset classes. There are categories of investment. So there are 5 asset classes. You've got equities, which is often the kind of professional terminology we use, the jargon that we use, but essentially that's stocks and shares. That's probably the most popular asset class, right? Do you want me to explain?
Yeah,
in a bit more
please
detail?
do. Yeah,
Right?
love it. Yeah.
So
I
always
love
say-
your explanation. So yeah,
I like to teach, so I like to
Yeah.
go into detail
I can
for people
tell.
to
I
really
can
understand. So let's say you wanted to, Savvy Wallet, right?
Mm-hmm.
Let's say that was a limited business that was, let's say it was a public business, sorry. So it was trading on the stock market and I could buy shares in it. Well, why would you even want people to buy shares in your business? Why would you need any of this stuff, right? It's because you want to raise capital, right? And so if you want to raise capital, you can do it generally 2 ways, right? You can say, Jax, I heard you're Mr. Jax Financial, you might have some money stashed and I need some capital to take my business to the next level. Can you give me £20,000? And I would say, okay, well, £20,000, what do I get in return? And you can say, okay, if you give me £20,000, I can give you 5% of the business, right? A bit like Dragon's Den.
Yeah.
And I have a decision to make. As to whether I like that. I can ask you some questions. Hey, what's your revenue? How much revenue do you generate? How much cash do you have already? Who else is invested? How much debt do you have already? Kind of thing. So I'll ask these questions. But essentially, if I like your business and I want to be a part owner of your business, then I'll buy shares in your business, right? So that's what stocks are. Stocks are buying shares in businesses that are publicly traded, so everyone can buy shares in these things. You may say, actually, I don't want to give up any piece of my business, right? But Jax, if you borrow me £20,000, we can come to an agreement and say, for the next 10 years, borrow me £20,000, I'll pay you 5% interest every single year. And on the 10th year, I'll pay you your 5% interest and I'll give your money back. What we've just created there is a bond, right? It's a contract.
I like that, the way you say it, bond.
It's a bond, right?
I like that. I never thought of it that way. A bond.
It's
yeah,
a bond.
that's
We're
amazing,
bonded for the 10 years, right?
Yeah.
So that's another asset class, which is it's called a fixed income security because the interest is fixed, right? So I've already given you 2 asset classes. Remember that contract we have is also a tradable security. You can go and sell that to someone else, or I can go and sell that to someone else, and then you owe that person. So that's how bonds work. Okay. Remember, you can borrow to corporations, but you can also borrow to governments. So you have corporate bonds, you've got government bonds. Anyway, equities, fixed income, that's the professional terminology, but you can also call it stocks and shares and bonds as well. Yeah. 2 asset classes. Then you've got a third asset class, which most of us know, which is real estate.
Yes.
Or property, which is another asset class, which I don't need to explain. I think people understand that quite well. You've got another 4th asset class, which almost captures all the other asset classes, and that's called alternatives. And under alternatives, you've got things like commodities, like gold, oil, wheat. Yeah. And, the rise of cryptocurrencies probably sits under the asset class of alternatives as well. That's the 4th asset class. And the 5th asset class is cash, because you can earn a return on your savings. So those are the 5 asset classes that anyone that wants to invest in anything, I guarantee one of those things will fit in those categories.
Amazing. I love all of it. So explanations, especially the bond one. I never really thought about it. Like there's like you're having a bond with somebody, a company, right?
And bonds have what we call superiority over equity. So if your business now goes into bankruptcy and it's about to be liquidated, and you're liquidating all your assets, you will pay your bondholders first. Okay. Right, before anything that's left will go to the shareholders, the equity investors, but the bondholders tend to get paid out first.
Amazing. So let's talk a little bit about the pros and cons, because everybody for some reasons always like stocks is like what lights up a lot of people's eyes. Stocks or crypto, that's what everybody I want to invest in Amazon when they're thinking of getting into investing, or Tesla or whatever, right? What are the pros and cons of investing in stocks and shares?
I mean, there is a risk of permanent loss, right? So permanent loss essentially means if you invest in something, capital is always at risk. Yeah. And so you can lose money. You can lose more than what you've put in. So I think we start there and we just acknowledge that does exist. It is a real thing. And what I've seen out there is, when it comes to investing in stocks, it can sometimes fuel gambling mentalities from some people as well. So I always say, whenever you trade your cash for something, like I was saying before, whenever you invest, you're doing one of 3 things. You're either investing, you're either speculating, or you're either gambling. Okay. So I try to encourage people to think about what they're doing when they buy shares in a company. Are you actually investing? You know when you're investing because you've asked the right questions.
So that somebody told you on Twitter, or your friend told you, Tesla's going up. Buy some Tesla shares.
Exactly. So and look, I'm not gonna bash anyone for speculating or even gambling. I just think it's important to be honest as to what you're doing, because when you're honest, then when the outcomes, manifest, then you can actually do something about it.
Yeah, true. Yeah, fair enough. Okay, so the other popular thing is index funds and ETFs. Yeah. Can you briefly explain that? Because we didn't talk about what those are, but a lot of people hear the terms index funds and ETFs. What are they? Yeah. And again, what are the pros and cons of investing in an ETF and index fund?
Yeah, so going back when I was talking about the different asset classes, now of course you and I and other investors can go and individually buy into these assets. Mm-hmm. We can buy shares in individual companies, we can invest in bonds, we can buy real estate, we can buy all these asset classes individually, but it's going to be expensive, right? It's going to be expensive, and we may not have the expertise in all these different asset classes to be able to buy them and understand them, etc. But what we can do is we can buy it in one pooled vehicle. So, Exhibit A, index funds and mutual funds. Essentially, what these are essentially pooled assets, collective assets, where you have all these different assets within the one asset. The analogy I've seen and I've used myself often is, rather than going to buy chocolate, I went to Sunday school, right? And let's say the Sunday school teacher said, today we're going to have a party, and I'll give you a budget of £50, go and buy some chocolates and stuff like that, and then bring it to the Sunday school. I can go and try and say, let's buy some Twix and some Snickers, and I don't really know what else to buy, right? First of all, it's going to be expensive. And if I buy one Twix, that's like 60p now or something like that. So rather than actually trying to pick the best once myself, why don't I just buy the celebration box?
100%, yeah.
Right? If I buy the celebration box, you're gonna have a whole bunch of stuff. You're gonna have bounty in there, which I'm not a huge fan of. But
Nobody likes bounty,
do you know what I
man.
mean? So, but you have all these different chocolates in smaller chunks, right? And it's cheaper, right? And yeah, and that's how index funds or mutual funds work. They are collective assets. Mutual funds are different. They came first. Essentially, you have a fund manager who actually actively manages all the people that invest in it. They actually pick the stocks or the assets in that fund and they try to outperform the index. But history and data shows us most people can't do that. Most fund managers don't. Hence, index funds and their popularity. They're usually more cheaper. So the management fee that they charge is much, much cheaper than a mutual fund. And again, the data shows us that most index funds over the long term outperform mutual funds. And then you have ETFs, which are very similar to index funds. The difference is how the product is structured. I always say index funds we say they're open-ended. So when you're buying an index fund, you're not buying tradable securities. You're buying into the fund. You're depositing into the fund.
Okay.
Whereas ETFs is a product in itself kind of thing. So you're buying shares in it. And I guess the most important thing is the implications of these things. And the implication of an index fund is when you put your money into an index fund, you never really know the price you're going to get. And you don't really care. It's a long-term vehicle. All you want is the underlying exposure of the actual assets. And it's quite similar to an ETF, but the difference is an ETF has what we call real-time pricing. It's actually a tradable asset on an exchange. So when you're buying it and selling it, you know the price
You can see the price
So
straight away.
you can trade it basically.
Yeah. Actually, I love that you explained that because that actually reminds me, I think when I first ever started investing, it was an index fund and I think it was on Fidelity. And the reason why I chose Fidelity was because I think I had like one of my company pensions there. So I was just like, I might as well use Fidelity. And I remember when I bought I was trying to invest, I think I was investing into an index fund. And I remember they didn't tell me the price straight away. I think they told me either the next day or the evening or something like that. So it's like you say, it wasn't like real time. It was like, okay, I want to buy this. They will say, we think it will be this price. And then, versus actually ETFs on another investment app that I use is like, okay, you buy this ETF for £1.
Yeah.
You get X amount of shares or whatever.
And it's really important that people pay attention to the difference between ETFs and index funds. Yeah. I say that because a mistake that I found a lot of people that have come to me for one-to-one coaching is they've consumed a lot of US content. Yeah. And the thing about US content is they are heavy on ETFs. But ETFs, not that they're not for everybody, they have implications because they are tradable securities. If you buy those assets on a platform that charges dealing fees, you're going to pay a price for that. Yeah. So most platforms won't charge you a fee for investing in an index fund or a mutual fund because they are open-ended. It's not a tradable asset. You don't trade it on an exchange, right? But the mistake of one client, he came and he was showing me his portfolio and he bought like 4 or 5 different stocks and ETFs. And he paid like £10 or £12 or something like that each. What? Because remember, ETFs are tradable assets. Wow, so
that's expensive.
There's a dealing fee. And you've invested £100. Bro, you've already lost 10 to 12% of your investment.
That's crazy.
So you have to pay attention to that. If you're buying ETFs, make sure you're buying it on a platform that doesn't charge you those fees.
Yeah. Quick question. What does open-ended mean? What does that that in the investment world? What does that mean?
What does it mean? I'm going to try my best to make it simple. Open-ended basically means when you are depositing more money or buying more shares in these index funds or mutual funds, they just create new shares.
Oh,
right.
Okay.
It's not closed. It's not like we already have the company and then you're just buying. You're just trading the assets between people. No, when you buy into an index fund or a mutual fund, they create new shares. Okay. And what that means is, and how it works mechanically and operationally, is there is a set time in a day where they look at all the people that have invested throughout that day, and they calculate basically how much that fund is worth, right? So they call it the NAV per share. Okay. So the person who does it is called a fund accountant, right?
Okay.
They look at all the people that have invested, look at all the assets that are in the portfolio, and then they do a calculation and say, okay, now this is the price. But that happens once a day.
Okay.
It's not
And then
continuous.
that's the price
And
that
then
you
that's
will
the
buy
price,
at when
yes.
you. Okay.
Yeah. So
Okay.
and every time someone new wants to come, so if we started the fund and then someone
Yeah.
new wants to join,
Yeah.
we would just create another share.
Okay.
And then we'll divide it.
And then the
according-
value of the fund keeps on increasing.
Exactly.
Okay,
And then you
okay.
divide it across how many people that have actually, you know.
Okay. Wow.
Yeah. Whereas others are more,
Yeah.
you know, it's an asset, so you just trade it. And I'm trying to make sure it's very well understood, because many people don't understand that even when they buy shares in a business, in a stock, you're not giving the company new money. Often you're buying shares from someone else. Someone else is on the other side of that trade. So you're not actually giving the company new money. It's a tradable asset.
I love that. And what would you say are some of the cons of? You mentioned some cons of ETFs. What about index funds? Index funds should get some cons too. They really make it seem like it's just like they're perfect.
No, I'll give you the real. They're not perfect. There are two cons that come straight to mind when you mention that. The first one is when people talk about index funds, most of the time they are talking about single asset class index funds. So they'll talk about the S&P 500. Again, if you're consuming a lot of American content, they will always bang on about the S&P 500. Amazing index, has performed amazingly well. But remember, it is just American centric, right? So the first one is, be aware that a lot of the time when people speak about index funds, they're talking about one asset class. And that one asset class comes with its implications. The second one is the fact that if you're investing in an index, you're going to be exposed to companies that you may not want to be exposed to. So earlier when I was talking about the charities, for example, not wanting to be exposed to companies that do, for example, animal testing, or, you know, if you're a church and, you know, you don't want to invest in Tesco, you're like, why can't you invest in Tesco? Because Tesco generate 5% of their revenues from alcohol. You don't want to invest in the FTSE 100, right? Because it's also got a whole bunch of tobacco companies.
Yeah.
So you have to be aware that if you don't if you invest in an index, you do have that kind of, you know, indirect exposure to assets that you may not really want to invest in yourself. So there is that element. And the last one is quite similar to the first point that I made, is when people are investing, they should really be thinking about their risk appetite. And what many people don't do, and we can talk about the process, because I think there is a real process to investing that people sometimes don't pay attention to, is you have to pay attention to what your risk level is.
Yeah.
And if your risk level is between 1 and 7, and you say to me, Jax, my risk level is 4 out of 7. Well, then you probably shouldn't be in an index fund or a single asset class equity index fund.
Interesting.
Right?
Okay.
Because if you were to look into the fund, and if it's an index fund, it will have something called a key investor information document. It's called a KID. If it's an ETF, it will be called a fact sheet, I believe. If you read into it and actually read it, it will give you the risk to reward level, and you'll find it might be 5 or 6 out of 7.
Okay.
So then that actually doesn't match your risk appetite.
Your risk appetite.
So you shouldn't be in that index fund.
That's quite interesting, actually. You know, especially that you're talking about risk, right? There's a level of risk that people want to. Now that you say that, I do remember a lot of like S&P 500. Top of my head, I think I've seen 6 for some of them. I mean, you see 5 maybes, like you say. Talking about, just again, so that we make it super clear for everybody, index. When we say index, what does that mean?
Yeah. That's
Again,
a good question. I think we have actually,
I just want to make sure that we hit all points so everybody's quite clear that we're not talking like, what are these guys talking about?
Yeah. So an index is just a list. It's just a list of companies that exist. It's often a list based on the size of a company or companies. In the UK, we've got a list called the FTSE 100. It's the largest 100 companies. We call it largest publicly traded 100 companies that exist. So it's just a list. The S&P 500, for example, is the largest 500 companies in America. So yeah, that's what an index is. It's literally just a list of the largest companies, and often it's the size. But you can have indexes that are, you know, weighted towards things like sectors and stuff like that. But easiest way to think about it is just a list. I was talking to one of my younger brother's friends, and I was trying to explain to him what like a mutual fund or index fund is. For any football fans, this is what I told him. I said, look, if you can decide to invest in like when I say companies, footballers, individual footballers, right? And say, I think this footballer, he's 19, but he looks promising, right? I want to invest in him for example's sake. But we don't really know if his career is going to do as well as we think it's going to do. So why not invest in the whole team?
Yeah,
for example.
Okay.
And so that's like investing in let's say the FTSE 100. You invest in the whole team. Manchester United, well, probably not now, but
not now. That's a losing investment. Arsenal.
so
or Man City.
Yeah,
Man City is like a given, basically.
Do you get what I'm saying? So there's that. But if you wanted to invest in a global index, which is investing in all the biggest companies in the world, you might just invest in the whole Premier League, for example. So I was kind of just giving him that kind of analogy to understand that. You know, you don't have to pick individual stocks. There are lists that already exist. Like there was a list of the top 20 football clubs in the UK. It's called the Premier League. But also notice there's relegation battles, right? So every year, 3 teams are relegated and then 3 teams are promoted. Similarly, in index funds, there's often a relegation battle and stuff like that.
I like that, liking it to football. And it's funny because you can liken a lot of this stuff to a lot of sports.
Absolutely.
Basketball, if you like basketball, hockey, tennis, you know. Okay, so let's talk about in terms of index funds, because, you know, I think a lot of the advice out there is just bang it in a index fund and go to sleep and wake up in 20 years and you're going to be a millionaire, whatever, right? In your opinion, should everyone invest in an index fund?
So I think the advice is not terrible advice, but it's not complete in a sense that, you know, yes, I think generally speaking, if you bang it in an index fund and you go sleep for 20, 30 years, I think the chances are you would do pretty well. But it's not that simple because we are human beings and we have emotions, we have risk appetites and that kind of stuff. So I think, like we were saying earlier, it's important to really read the key investor information document and double check if the risk matches your risk appetite. And then, like I said earlier, you know, the index you're invested in, does it include or exclude certain companies that you don't really want to be invested in or you want to be invested in? Something to really think about as well. So I think those are the 2 things that come to mind. And I think the mistake that many people make is when they hear index fund, they only think about the single asset index fund. There are multi-asset index funds as well. And for most people, that might be the way to go.
Yeah. I like the fact that you reminded me of multi-asset, because like you say, people are thinking, you know, S&P 500, which is the biggest 500 or most valuable publicly traded, like you were saying, US companies, or global, and that's it. We can't do any more. Like there's not other sectors or other areas in the world that are also going to grow or become better. Yeah. I
mean, I like I said earlier, I think, yes, most people would do very well by just sticking it in an index and waiting for a couple of decades, and they would have done well. I truly believe that. Yeah. But as someone who has been on my own wealth journey, one of the examples I give to people was I managed to build a 6-figure portfolio before I turned 30. Wow. And I was really aggressive about it. It was obviously I work in the industry, so I understand the benefits of getting to that number quite quickly. But the one thing that I didn't really focus on and understand truly was my own risk appetite. Things are great when it's going up, right? But when it's going down, it can be quite tricky. So when you have a £100,000 portfolio and you haven't really built the emotional intelligence or experience of seeing volatility in your portfolio, it can be you are hit with periods of fear, periods of euphoria, periods of despair, you know, because a 5% move in my portfolio now, when I had £100,000, means a £5,000 change.
That's crazy. Can you imagine?
Do you get what I'm saying?
One day seeing 5 minus 5,000.
Do you get what I'm saying? And I remember at the time, I don't earn £5,000 a month. So why am I seeing changes in a week more than my monthly salary? And that starts to really affect your emotions. And so, yes, if I stuck in an index fund and just closed that account and, you know, didn't open it for 20 years, I would do very well, I think. But I'm a human being. I'm going to check, right? Yeah. And it kind of caused us to make irrational decisions. So what I then done is I re-diversified, changed the portfolio around, took some out, bought property, got myself married. I always tell my wife that even her engagement ring came from my portfolio. So there is a case for really understanding individuals and our emotions and our risk appetites. It's not just about getting a high return.
Yeah. And is an index fund a good place for beginners to start like their investment journey?
Yeah.
If because we're probably gonna get a lot of people that want to start investing, but they think, okay, how do I start?
Yes and no, both. Yes, in a sense that, of course, it's a very well diversified way to put your money into the best companies in the world. However, I always say when you are starting your investment journey, one of the questions you have to ask yourself is how involved do you want to be in the investment decision making? And there are different routes you can take. I categorize it into 3: passive, completely active, and somewhere in between. And if you are completely passive, you can actually outsource it to, for example, a private client investment manager. I'd say if your net worth is over probably 6 figures and above, then maybe you can go that route because they'll actually look at you. Or you can use a robo-advisor. I'm a huge fan of robo-advisors. You go on there, they use algorithms to create portfolios for you, but you're completely outsourcing it to the platform and they will do everything for you. And that's okay for some people. You don't have to go and buy your own index fund, right?
Yeah.
To be fair, the platform probably will buy index funds and ETFs, but it will know how to mix and match to suit your risk appetite.
Yeah.
And then you can try be the next Warren Buffett and try pick your own individual stocks, which for the 95%, 98% of people is not the way to go, if I'm really honest. And then you could be somewhere in the middle where you can pick your own mutual funds, index funds, and because they are, even though you're making an active decision to buy them, they are passive investments.
Yeah.
So that's why I say yes and no. It really depends on the individual. But if someone said to me, Jacques, I've invested in just index funds, I would say that's not a bad idea. But just be aware of the volatility and make sure it matches your risk appetite.
Amazing. So money, people are probably thinking, okay, so how do I actually make money from investing? How does someone actually make money from investing?
Yeah. So going back to the asset classes, 5 different asset classes, you find that you generate 2 types of returns from investing in assets. One will be something called natural income. So the natural income is the way the asset will provide you with a return without you having to sell the asset. Natural income from equities be dividends. So dividends are essentially a way for the company to pay shareholders, to reward its shareholders through its profits, share some of those profits with the shareholders. That's the natural income from stocks and shares, also known as equities. For fixed income or bonds, like I was saying earlier, is the interest. Like you pay, that bond that we had, every year you pay the 5%. That's the natural income. I don't have to sell this asset to anyone else to generate that natural income. Property is obvious. If someone's paying you rental income, you don't have to sell a property to get a natural income. So natural income is one of the ways to receive your returns. And the other one is selling your asset for profit, also known as capital gains. So shares can go up in value as the businesses become more profitable, as they grow, their share price tend to grow with it, and you can sell it to someone else for profit. Same as property, as you know, you can sell your property for a higher price, and bonds as well. So generally speaking, 2 types of returns, the natural income and the capital appreciation are the returns you get from stocks. And if you have it in an index, then obviously it's everything mixed in together.
Yeah, amazing. And then in terms of, because now we want to prevent tax, right? What is obviously one of the ways that you can prevent being taxes on your investments through a stocks and shares ISA. What is the stocks and shares ISA, and I guess what are the benefits?
Yeah, so stocks and shares ISA is probably my favorite account. As I said, it's an account. Essentially, it's a home for your investments. That's how I like to put it. It's where you actually buy these assets. So when you want to buy a mutual fund, an index fund, or shares, you want to buy it inside and hold it inside. For example, a stocks and shares ISA. And the reason behind that is what I've just described. You might get interests, you might get dividends, you may get capital gains, property income. As long as the home for your investments was in the stocks and shares ISA, there's no tax to pay.
Yeah.
So it's a tax efficient wrapper. That's what it's called, a tax efficient wrapper. And for me, it's my favorite type of investment account for now because of the flexibility. You can access your money whenever you want. You can take out money out whenever you want. There is a limit as to how much you can put in there, which is £20,000. That is at the ISA level, because there are different types of ISAs. You can decide to put all of your £20,000 allowance in a stocks and shares ISA. But for now, it's my favorite account because it's flexible. Of course, the other amazing account for investing long term is pensions.
Yeah. And what I like about the ISA is save on tax.
Yeah.
We love saving on tax.
Yeah.
You know, imagine you were, I don't know, if you were a great, legendary, like Warren Buffett style investor. You invested, I don't know, for let's say you invested 20 years. Let's say you even just did 10K a year. And what was that? Like about 200,000, right?
Yeah.
I'm not going to get taxed on that.
No tax.
Right?
Yeah.
If that was on the capital gain side, or if it was just in a general investment account,
you pay tax.
Getting tax.
Yeah.
I don't want to pay tax.
You know, an amazing thing is it doesn't matter how much it grows up.
Yeah.
It can go to millions and there's still no tax to pay.
Exactly.
As long as the home for it was your stocks and shares ISA.
Yeah, it's crazy. And actually on that note, right, I was reading on Friday something from the FT which was very, very interesting. So according to Financial Times, over 22 million people have an ISA. Populations of 6-7. So it's still quite a decent amount. About 30% of people. So a third of the UK population have, but obviously that means that about 45 million-ish don't have one. And then of that, 14.9 million hold a cash ISA and 3.9 million hold a stocks and shares ISA. So less people hold a stocks and shares ISA.
Okay.
Yet, according to AJ Bell, 456 billion is held in stocks and shares ISA versus 285 billion in a cash ISA. So my thinking is, why aren't more people opening stocks and shares ISA? Even though you can see that way more people have more money.
So it's like there's more people that have cash ISA accounts.
Yes, exactly.
But when we look at how much money is inside the stocks and shares ISA, even though there's less people, there's significantly more money. Yeah. That doesn't surprise me in the slightest. Yeah. Because I think there was a lack of knowledge problem. So historically, whenever I mention the term ISA to anyone, the first thing that comes to their mind is a cash ISA. Even when we went through periods where the interest that the people were earning on their cash ISAs were ridiculous, people still felt the need to open up a cash ISA as a savings vehicle. And so I'm not surprised by that stat at all. I think the truth of the matter is wealthy individuals they're usually more knowledgeable. They usually have financial advisors and stuff like that who will tell them that if you have more than a 5-year time frame for your cash, you probably do not want it in a cash type instrument. You do not want it in a cash ISA. You want to take a level of risk with your money, and risk is not a bad term. It just means you experience some volatility to earn a higher return. The biggest risk for anybody that has more than a 5-year time frame is actually inflation risk, right? Whereas the biggest risk for someone who has a short-term time frame is volatility. So I think there's a misunderstanding or there's a lack of knowledge as to how scary inflation actually is for the individual person who may not actually understand inflation that well. But trust me, wealthy people that do have financial advisors that understand that inflation is the biggest risk to anybody who's got a long-term time frame, they will definitely have it in a stocks and shares ISA. Yeah. So I think there is just a knowledge problem and just an awareness of the fact that stocks and shares ISAs is probably where you want your money to be in, and the assets underneath that are things like equities. Yeah, I think that's the main reason. And I also think the second reason probably could be, it's quite similar to the first reason, but it's probably the fear. I think there might be a fear of losing money and just not understanding how to invest, right? Yeah. So if you if you put your money in a cash ISA, you see the interest. You never really see your money depleting. Yeah. There is no risk. It's risk-free. We call it a risk-free rate, right? But what you don't realize, what your naked eye can't see, is the impact of inflation.
Yeah. Imagine it was going down slowly. Imagine inflation could be applied to your finance.
Then you will see the risk. Then you see it going
let me
down.
go for the investing thing. Yeah, correct. That's probably what you would do.
Yeah. So people are afraid to see their money bounce around. I'll tell you a joke. My mum knows what I do. And one day I spoke to her about, potentially why she doesn't have an ISA for me, that kind of stuff, an investment ISA. And she's like, you know what? When you were young, Jacques, I opened up one with a bank, but the next day I went down and and the money had gone down by like 3%. I said, no way. No way am I going to put my hard-earned money in something that's losing value. And I think that's the lack of education part, just not understanding that volatility is the price that you pay to beat inflation. Over the long-term, history has shown us since 1900 to the data, last time I checked the data, 1900 to 2023, the stock market, equities, US has provided around a 9.5% return.
Wow.
The UK just a bit less than that, still above 9%. In that time period, inflation has averaged about 3.8%. So equities, stocks and shares have always proven to be the one vehicle that grows your capital ahead of inflation.
Yeah.
But in that 1900 to 2023, it's not been smooth sailing. We had the Great Depression, 1920s, 1921, 22, 23. There was a Great Depression. The stock market dropped by like 60%, right? We've had the oil crisis. I think that was in the the 70s. We had the oil crisis. We had the dot-com bubble in the late 90s, early 2000s. We've had a global financial crisis. We've had so many things. We've had a pandemic. And in those times, the stock market tanked, right? But guess what? It has always come back up, kind of thing. So there is going to be times where we go through some very diabolical situations, but as history has shown us that we often come back even stronger.
Yeah, amazing. That's what I love about investing. There's a huge history behind it to show you that it works, and we're gonna always need it. So okay, so we go into mindset a little bit, right? Because that's quite important. You talked about fear. I think it's a good time to touch on it. Fear, seeing your money go down. I mean, even for you, man, I mean, it's hard. I think for anybody, even a seasoned investor, to see like $5,000. And if you imagine, right, you had $1 million portfolio, 50K down, you're going to be like, no matter what anybody says, losing 50K, if you told somebody I lost 50K, they'll be like, what are you talking about? So I guess in terms of that, all right, what are the key rules that like every investor should abide by?
I think there are some obvious ones that most people may have heard about. So we know that it's time in the market rather than trying to time the market. Essentially what that means is it's better to just stay invested than to try to say, oh, I'm going to buy here and then I'm going to sell out and then I'm going to come back in. Most people won't do well doing that. It's been proven time and time again. So stay invested. As I said, the history shows us the stock market has always bounced back up. And the reason behind that, I would say it's good to understand things, just not just know it, you have to understand it, is there is a strong correlation between economic growth and corporate profits. And remember, by corporate profits, I mean just businesses being more profitable as the economy grows. And of course, when you buy shares in a company, you're buying into the corporate profits. So as long as you believe that the economies are going to continue growing over the long term, so if you believe that in 20 years, the economy is going to be stronger than it is right now, bigger, more productive, more profitable than it is right now, then you can understand that, yes, you might go through some volatility, but you will make money, basically. So it's about staying invested and staying invested for the long term. Another keyword, long term. If your time frame is less than 5 years, you probably are not investing. You most likely do not want to have your money in a volatile asset with less than a 5-year time frame. Yeah. You probably want to be in things like government bonds and other cash type instruments, not equities. So it's time in the market, not trying to time the market. It's being aware of gambling mentalities, as I said earlier. Super important. Like don't gamble. Speculation, for some people, they can play games of investing. I'm not completely against it if it's something you do aside from your actual investing, but just be honest about it to say this is a punt, this is speculation. You haven't really done all the research. There's nothing to really say that this is going to do well. So yeah, I think that's the first one that comes to my mind. Just really understanding that investing is always a long-term thing. Stay invested, invest a safe amount, and continue to learn about what this thing is and how it works. And the more educated you become, the more you have the knowledge, the information, the more you can understand and comprehend what you're learning and apply wisdom to it, you will definitely do well.
Yeah. And then what are like some of the common mistakes that new investors make, or even seasoned investors as well? So even seasoned investors make
we continue to make mistakes. I continue to make mistakes. I think first we have to acknowledge that we're human beings. And that's why I was saying earlier, even though we may know something, we don't stick by it because we're human beings, we have emotions. And the reason why most people are bad stock pickers, I've said this quite a few times, and most people are bad investors.
Yeah.
And it's hard to understand. It's like, how can we be bad investors? How do we lose money in a vehicle that's been going up for many years, right? And it's because most people don't understand the emotional side to it. We are human beings, and there are two psychological biases or categories of biases that we have. Well, one is our emotional bias, right? We have our emotions, right? And the other one is what we call our cognitive errors. Cognitive errors is essentially how we process information, right? So a common one is like confirmation bias, for example. And then we have just our emotional biases, how things are framed. No, framing is more of a cognitive bias. So when you frame something, I could say two things to you, but if I frame it differently, your outcome is different.
Yeah.
So I think the most important thing is to understand our cognitive errors and our emotional biases. Go read up on it. There's confirmation bias. There's loss aversion. Loss aversion is, I bought a stock, it's down 10% today. The 10% downward trend is warranted. It should be down, but you don't want to sell it. And you don't want to sell it because you don't want to make the loss a reality. Right? If I give you £5 today, your marginal gain, your utility, how you feel about that £5 gain is not as high as if you lost £5.
Yeah.
Right? So the weight you attach to the loss is much higher
Okay.
than
That's
the weight you attach to
interesting.
the gain. So we have loss aversion, and that causes us to make some irrational decisions as well. And there's so many of these things. Another one is anchoring. Anchoring is a very, very, very strong one. Anchoring is, you know, if you go sales, if you go to a shop and you see a lovely jacket that and they say this used to cost £500, but now it's £250, right? Half price. You are more likely to buy that thing than if you went to that shop and there was no sale sign, but it cost £150.
That's true. That is
right?
very true. Yeah.
Do you get it? So that you see how our brains,
all these tricks that the stock market play a lot of tricks on you.
And it's not even the stock market alone. It's just marketing, even. It's marketing. Right? Yeah. So as human beings, we're not really kind of created very well to be good investors because our brains, we have cognitive errors and emotional biases. And I've seen that in the stock market a lot of the time. Oh, buy the dip. The thing has been flying. The stock price has been flying. It's only dipped by 5%. But because of the anchoring, you've anchored that price to the highest price, and because it's dropped a bit, you say, okay, I'm going to buy the dip. You buy the dip, and it might be a stock that's going down. We call it catching a fall in life, right? You've anchored your price to where it used to be.
Okay.
Whereas if it was starting here and it shot up to just below, you won't buy it because you don't see no dip, even though that price is less than the dip. Okay. Does that make sense? What you mean, yeah. So as human beings, there's just so many things against us for us to try and do stock picking and timing things. Yeah. We just end up failing. It's like playing a roulette. The more you try to do it, the more you give the opportunity for yourself to make an irrational decision.
So how do we become better then? Like with our mentality, what are some of the things we can do?
Yeah. So I always say that if you're trying to build anything, become more knowledgeable. Yeah. Try to understand things and apply wisdom. So in terms of how to become better investors, become more knowledgeable, become more informed, get the information as to how the stock market works. Earlier I was saying, okay, we know the history since 1900, the stock market has been going up, providing about 9.5% return per year. So we know that now. It's information. The second part is understanding. So comprehend it, right? This is comprehension. So how do we comprehend that the stock market has been going up? Okay, we understand now that corporate profits is a big part of economic growth. And so as long as the economy is going to grow, corporate profits are going to grow. If corporate profits are growing, dividends are going to grow. If dividends are growing, share prices grow. So once we can comprehend that, as long as the economy is going to keep growing and companies are going to be more profitable, if I just buy the index, for example, if I just buy the whole economy, then I should do well over the long term. That's the comprehension part. And wisdom is actually applying it. It's actually doing it. But yeah, bro, I also do think it's about learning about yourself and learning your own psychology. Yeah. So one of the things that I think helps a lot of people, not just with investing, but personal finance as a whole, is learning how to budget effectively. and taking a proportion of your income and investing it. I think automation is a cheat code. If you can automate things, that would really, really help.
Okay, amazing. Okay, so let's talk about step by step. Step by step, how can someone make their first investment today?
Geez, all right. So I think there is a strategy. So I will go through what I tend to teach people is number one, there's five steps. One, what is your objective? What are you even trying to achieve with your investment? Start there. Is it I'm investing so that I can retire in the next 30 years comfortably? Is it I'm investing for my child? I just came out from a conversation with one of my boys. Him and his wife have given birth. Are you investing for a child so that when the child hits 18, they have the tuition fees ready, for example, for university? Is that the objective? So you have to start with an objective in mind. Second is what is the time frame or the time horizon? How long do you have before this investment has to manifest?
Yeah.
Is it 5 years? Is it 10 years? Is it 20 years? You have to note that down. And the third one is your risk appetite, which we've spoken a bit about today. So your risk appetite is both your ability and your willingness to take risk.
Yeah.
Ability means look at your capacity for loss. If you were to lose all of this right now, can you still live your life? Can you still continue? Kind of thing. That's your capacity for loss. And then your risk tolerance, your willingness comes down to, well, how willing are you to see fluctuations? You have to try and combine both. That's the starting three, and these three all work together. So the longer your time frame, the more risk you probably can and should take, for example. And the shorter time frame, the less risk you want to take. So they do work together.
Yeah.
The fourth one, I've mentioned it earlier, is your involvement. Actually, before we get to involvement, the fourth one should be, is there anything unique about your circumstance? Do you not want access to certain assets? Do you have ethical restrictions? Do you say, oh, I want you to exclude tobacco companies? Or that's called negative screening, by the way. Or do you want to do the opposite way, positive screening? Do I want to include companies that are fueling positive change, for example? Think about that if that's part of your investment. And then finally, your fifth one is, your involvement. How much involvement do you want? Do you want to be active? Do you want to be passive? Do you want to be somewhere in between? Active, I don't often push people that way because most people are bad investors, like I've just said.
Yeah.
Passive, then you can decide whether you want to be completely passive,
Yeah.
just outsource it to a robo-advisor, for example, or a platform that will just do everything for you, right? Or somewhere in between. Now we're talking about actually investing in things like index funds and mutual funds. So that's where I will start. That's where investing really begins, kind of thing. It's not just about, I just want to buy shares in Nvidia because it's been going up. That's you can.
Yeah.
And I'm not completely against people investing in companies that they like or companies that they consume from. I don't think it's the worst thing, but ultimately investing is there to achieve a goal.
Yeah.
And you want to build a portfolio to achieve the goal, not just investing in things here and there.
Yeah, I love that. That's, I completely agree. It's not about just flinging money into an index fund or stock just because, like you say, what is the actual outcome? And talking about outcomes, right? Like you said, you were able to build, 6-figure portfolio, right? So, again, a lot of people would want to build wealth. So how does someone from a working class background start to build wealth through investing?
Yeah. The first thing is to, I've kind of mentioned something like this already. There's a scripture in the Bible that I love, not to get too spiritual, but it talks about building a home, right? It says, with wisdom a house is built, and by understanding it's established. And then it says, with knowledge or through knowledge, its rooms are filled with precious things. Anyway, all that means is, again, wisdom, knowledge, understanding. Learn, get the know-how, get the information, right? So become informed so that you can make informed decisions. But don't just get the knowledge. That's not enough. You have to comprehend the knowledge. So understand what you know, really comprehend it. And then once you have the understanding, it's really then about application. But in terms of actually doing it, I think mechanically, the formula is very simple. It's a personal finance formula, as I say, or phenomena, which is income, expenses, assets, liabilities, right? You have to earn more than what you spend and then use the difference to accumulate assets, grow those assets over the long term, and given enough time, compounding would do its thing. and you'd be surprised how those assets can look after you in the future. But it's about starting in the mind first, really getting the mindset in the right place and believing that you can do so. And you may have to make some sacrifices.
It's true. A lot of sacrifices, man, for years, right? I mean, you must have had to make sacrifice for 10 years to build it 6 figures before 30 is mad.
Yeah. Do you know what? It's sacrifices. I think for me, I just recognized, again, it's about knowing my situation. I was honest with my situation, that I'm coming from a low income household. Working in finance, I've never sat next to someone who had to take out student loan.
Yeah.
Everyone I've sat next to, their parents paid for their school, their parents gave them deposits for their home. And so my honest reality check and engaging in my reality is I do not have that same kind of nepotism or background that they have. So I have to make some sacrifices that maybe they don't have to make.
Yeah.
And so one of those sacrifices, for example, was moving back to my parents, especially during the pandemic, because I didn't want to be alone for one. But I knew that it would be intelligent for me to move back to my parents. I still had a bedroom there. And rather than paying rent to someone else, I can help my mum out with a third of the rent. And I could use the difference to invest aggressively.
Exactly.
So these are some of the sacrifices that I made. And of course, other things were out there, crying out certain things and just being aggressive and making investing non-negotiable.
Yeah, I love that. I love that because you're definitely an example of what you can do if you're disciplined, if you make the right decisions, and like you said, you did it before 30, so you didn't even really miss out on much. Like to have that big of a portfolio and be like, actually, I'm still quite young. I can still go and do what them man are doing.
Yeah.
Do you know what I mean? Like,
I mean, look, you mentioned 10 years. In that 10 years, there were times where I was much more aggressive than others. So in the first 5 years, to be fair, my personal finance journey didn't kick off aggressively until I was about 25. So I did a whole bunch of lads holidays. Like I bought myself an Audi A5 cash. Like I did make some questionable decisions.
Even more impressive.
I did make some questionable decisions. But yeah, I just got to a stage in my life, and this is something I tell young people. I have a few mentees, and I just have to be brutally honest with them and say, look, there might come a time that you just have to say, for the next 2 years, 3 years, my main priority is I need to build my economic foundation, my financial foundation. And that looks like building your, not just your human capital, but building financial capital and making sure you get out of any, credit card debts, you save emergency funds, and you build a portfolio of liquid assets that can really start to kickstart the compounding journey for you to build wealth long term.
Amazing. So what is the ultimate outcome people can expect from investing? Obviously you talked about your outcome. This is not even your ultimate. This is like a stage in it. Again, so we can kind of contextualize it for people. And actually, I'm going to add a little bit of context to that because I was looking at the other day, right? The wealthiest people in the world. And so at the top of it, it was like the live index. It was the founder of Louis Vuitton, Moet Hennessy, Bernard, Jeff Bezos, Elon Musk, Mark Zuckerberg. Look at what all of them have in common.
Yeah.
They all own parts of their own companies. And they're the richest, 5 in the world.
Ownership is key, right?
Yeah.
I think we just have to be brutally honest and say ownership is the number one way to build wealth, right? I don't know who coined the term, but he said businesses and bricks. If you want to build wealth, you need businesses and bricks. So you invest in businesses. That could be your own business, that could be shares in different businesses, and the other one is obviously real estate. But the guys you've just described, absolutely, they own a big part of their companies. But not everybody can be these people, right?
Yeah.
Not everybody can own a business that's Louis Vuitton or Meta, for example. But we can own pieces of businesses. Everybody can buy shares in some of these businesses. All these businesses, like you said.
If you want some Louis,
do you know what I mean?
Get some of it. Yeah.
Do you know what I'm saying? So you can definitely be a part owner of these businesses as well by owning stock in them.
Amazing. So I want to end with this question, right? So in your many years as an investment professional, what would you say are the key lessons you've learned about investing?
Oh gosh, I think the biggest ones I've learned is that we have to have an investment plan, right? I think many people invest without a plan, but I also feel like the investment plan should be part of a holistic financial plan. So we still have to think about our insurance products. We still have to think about emergency funds, thinking about potentially paying down a mortgage. And investing fits all of that kind of thing. It's a holistic thing. I call it a portfolio perspective kind of thing. And I think that's one of the things I've noticed with the client portfolios that I've looked at, that they will have multiple portfolios for different things, different objectives, right? So they can have 4 portfolios. One portfolio is there to just, build their wealth over the long term, and it supplements their pension account. They have access to it because they can withdraw from it whenever they want, even before the pension age, because pensions are more tax efficient, by the way, because of the tax relief. But you can't access it until, for us lot, age 57 onwards, right? But your ISA, if you decide you want to retire early, then you can access it from 40s, 50s, whenever you want to access it. So really understanding what the portfolios can do for you. Some of it can even supplement your income. You can build a passive income portfolio, a high yield or dividend paying portfolio that gives you income every month. So I think it's important for people to understand that, yes, investing is not just about just sticking in an index fund or anything like that. You can actually build portfolios to meet objectives and to even solve problems. That's number one. And 2 is just try and avoid mistakes. Try and avoid withdrawing when you don't actually need to. Often the market bounces back because, as I said earlier, economic growth. Everybody wants economic growth. The government wants economic growth. The central banks want economic growth. We want economic growth. And as long as the economies are growing, the stock market should grow.
Yeah. And now a lot of people be like, okay, Hassan and Jacques, we've listened to this podcast episode, but I just want to keep it simple. From their perspective, what's the most simplest way for them to, start investing today?
The simplest way, I think I've covered it, which is thinking about whether you want to go the complete automated route, just letting a platform do it for you. That's the simplest way. So different platforms, I'm just gonna, if you don't mind, I can throw a few out there. Like,
of course,
I don't know, like Wealthify, Moneybox, Nutmeg. These are robo advisors that will just do everything for you. You have even traditional platforms like Hargreaves Lansdowne that will have ready-made portfolios, for example. So you can literally go on there and just read and then get things started. You can call, for example, Hargreaves Lansdowne have an amazing customer service. You can give them a call and they'll walk you through it. I wouldn't suggest for people to open up like a free trade account. And I'm not that I have anything against free trade. I'm just talking about a trading platform and just start buying stocks left, right, and center. That's probably the way not to go. And if you want to learn how to do that, there is a process. And I would encourage people to learn. If you want to be an active investor, if you think you could be as good as the Warren Buffett's, there's a process, bro. You have to learn how to read financial statements, income statement, cash flow statement, balance sheets, understanding earnings calls, understanding a good management team. There's a real process as to how to invest in individual companies if that's going to be your main way of investing. But I also don't have a problem with people, for example, applying my favorite strategy, which is called a core satellite approach, which is having the bulk of your portfolio in index funds, for example. It could be a single asset class index like a global equity fund or S&P 500. My favorite for most people will be a multi-asset. And I think most financial planners will tell you to go for the multi-asset index fund. That would be a core of your portfolio. And then you can, with maybe another 10% or 20%, you can decide to buy shares in businesses that you like and be a part owner of them. So why not?
Amazing. Thank you so much, Jacques. Really, really appreciate this conversation. I learned a bunch. And I've been investing for a little while, but I feel like I've learned a lot. And I hope that I feel like the watchers and listeners also feel like they'll be able to take a lot. And it's like you say. I think the most important is really what's the goal? What are you actually trying to achieve here, right? Because when you do go through those periods where investing can be tough, like you're like, oh, my money's down. You remind yourself of the goal that you're trying to achieve. Actually, I don't need this money in another 10 years. I'm not worrying about this. I don't need it in another 15 years. Let me check back in 15. What's going on, So I think that's very, very important. Where can people, find if they want to, connect with you?
Yeah, so I'm predominantly, I think, on Instagram. So that's Jacques Financial, JAX Financial. I also have an audio podcast, which I think I've mentioned earlier on. That's Woke Finance. We'll be on all different platforms. It's audio only. It's me and my business partner, Peter. We talk about all things finance and all things finance related. Those are the main two platforms that I have. If people want to book a one-on-one call with me, then they can do so normally through my Calendly link that will be on Instagram. And essentially what I do there is I'm not allowed to give you financial advice, but I can give you information and guidance. So a lot of people use me to kind of look at their portfolios, make an assessment, tell them about their portfolios to see if it actually matches what they're trying to achieve. Of course, people sometimes book me for tuition. And I do a lot of public speaking nowadays. As I said, I speak in churches now, which is amazing for me.
Love
stuff
that.
like that.
Yeah, and the people in the church, we need this because the charities are doing it. Look, church money, we got to be investing in that as well,
Oh, no, I mean, clients, I have clients at churches in terms of like even professionally.
It makes sense. It makes sense, right? Like you say, because there's going to be an ultimate goal of doing that, right? So, yeah, like I said, Jax, I really, really appreciate you, featuring on the podcast today. I think, you've shared so much value, so much value. Like it's so amazing. So do you have any final words for watchers and listeners?
Yeah, I think the key thing is investing is for everybody. I think that's the key thing. Investing is for everybody. Investing is not just about earning the highest return. So if someone comes up to you and say, hey, look, I've made 50%, that doesn't make them a great investor. There's a lot of luck involved. There's a lot of what we call survivorship bias. Another one of those biases that I probably didn't mention before, which means you only see some people that are successful. You forget that for every 10 people on Instagram that you see that have done something and it's shot up, there's another 1,000 that you don't see. But do you get what I'm saying? So being very aware that investing is for everybody. The economy tends to grow over time. I believe everybody should participate in the wealth of their nation and in the world that they live in. I believe there has to be economic participation, especially for people who grew up in low-income families. And the easiest way you can do that is by buying shares in the best businesses in the world and holding them long-term.
Love that. Absolutely love that. And you are right. We all need to participate in the economy. That GDP, when it's up there, we need to participate. Really appreciate you featuring on the podcast, Jax. Thank you so much for tuning in to this episode of the podcast, and we'll see you next week's episode.